Hey everybody, this is Ryan Mallory doing another episode with you guys here. Let's go ahead and talk about, because this is what we're in right now with the market. We're in a very uncertain circumstance. We do not know what the market intends to do from here. The S&P 500 sold off over 100 points, or almost 100 points yesterday. The Dow sold off over 800 points. The NASDAQ went down like 311 points, one of the biggest sell-offs that we've seen in a long time. So there's a lot of uncertainty, a lot of fear in the market right now. We haven't seen anything like that really since February, when the market just really took a nasty push lower. So what I want to talk about today is stock market bottoms, how to detect them, how to play them, what we should do while we're waiting for one. So the first thing that I'm going to talk about now is how to play the bottom, how to play the big sell-off that's currently underway, and how to spot what looks like a bottom. So the S&P 500, and nothing's an exact science with these bottoms. There's none of that I'm going to explain to you, a magic formula or anything like that. Really, a lot of it just comes down to experience and being able to understand human behavior as it pertains to the financial markets and apply trades as a result. Now, one of the big things that you have to do with the sell-offs is you have to manage your exposure. You have to manage the long exposure. If you're getting too long, too fast, that can really hurt you. If you are not managing with stop losses, that's going to get you in some big trouble. But you also have to be willing to fail. So you have to realize that you may not time it perfectly in the very beginning, but what makes failure okay when you're trying to find the market bottom is, one, not just doing it based off of feelings, but two, not trying to go all long at once or trying to go into margin or even go completely 100% long. Just try like a little bit. It's like dipping your toes in the water to see if it's warm enough for you to jump in. So you might want to try with one position, and then if that works, maybe add a second position, or maybe start off with two positions and maybe go for a third one. But what I'm trying to say here is you don't want to go all long all at once. You want to be very conservative about it, because there will be opportunities to continue to get long if it's truly a market bottom. Now, the best point in reference is the S&P 500's bottom, or pretty much the whole bottom, the market's entire bottom that was formed on February 9th of this year. And you can see, even when this bottom was formed, yeah, we finished in the green, but we actually went way down before we actually pushed higher. And so yesterday we had this huge sell-off in the S&P, and then we have follow through today. We almost thought we were going to get really ugly once again, but we've kind of come off of those lows, and right now the S&P 500 is trying to hold the 200-day moving average. And if you go back to February, that happened there as well, and we bounced really hard off of it. And then April, there was actually a close below the 200-day moving average, but the next day it gapped higher above the 200-day, and it kept running thereafter. So the 200-day moving average is very important right now. It doesn't mean that every bottom in the future will correspond with the 200-day moving average, but right now, until we see differently, that has to be really respected. And if you take today, I've already been wrong on one trade. I jumped in long on Netflix, put a stop below the lows of the day. I could tell that the market was going to go ahead and test those lows and probably push lower, so I jumped out of Netflix pretty much as soon as I got in. I took a small loss on it, but what I did is I was willing to fail. I kept my exposure small, and when I wasn't right, I went ahead and got out. And so that's one of the biggest things that you have to be able to do. And I talked about the exposure. Your success and these kinds of markets will be defined by how well you manage your long exposure. If you're just trying to say, oh man, this is the bottom, I've got to get long right here, well, then you're putting yourself in a situation to really fail. Now, you could also be right on it, okay? I'm not trying to take that away from you or your ability to determine what the market bottom is, but what I'm just trying to say is that if you're not right, it's going to be really bad, and you're going to have hell to pay for it, because the market has no forgiveness to people who just don't manage the exposure, don't use stop losses. It'll eventually come to bite you. So don't get too long, too fast. Be willing to sit on the sidelines for a while. If the market's just in a complete free fall, let it do its thing and let it finally try to find that bottom, and then start testing the waters when you think that there's a plausible chance that the bottom is being formed. Listen, we're not here to trade stocks to be perfect. and you're not going to be when you're trying to find a bottom in the market. But what you want to do is you want to trade with the understanding that you may be wrong. And if you do that, then eventually you'll be able to hit that market bottom. But in the meantime, you're going to make it to where it's not too painful of an experience, because the one thing that's for sure, when you have huge sell-offs like what we saw yesterday and the 4 days prior to it, and then the market does bottom, it doesn't just like move up a little bit, it moves up dramatically. So if you keep your exposure small and you take small losses along the way, and you're not getting like 100% long or even 50 or 60% long, you're really just saying, okay, I'm going to add 1 or 2 positions here and keep the exposure tight. Well, when the market finally does bounce, it's going to bounce in a huge way. So I'm going to show you today a couple of the positions that I've jumped into here in the splash zone. I got into Amazon at around 17.20 and 41 cents, and so far it's up about $10. Now the reason why is because look at this. If you look at the support level, it's trying to hold that support level, going all the way back to the February lows. That's a good sign. I want to try to play that with a stop below the rising trend line. I also got back into Netflix, and I got in around 325, so I'm pretty much break even on that, but it's playing with that 200-day moving average, trying to hold that. And this is a stock too that's held up pretty well, except for yesterday, of course, but excluding yesterday, it had held up fairly okay from the recent weakness in the days prior to it, and it provided some good trading opportunities. I actually had gone into it on 10.8 and made 3.2% off of it. So on this little move here, it was about 3%. So not bad, but we got to see whether or not this market wants to bounce for us. So right now, yeah, there's other trades that I would love to jump into. You got Apple. There's some potential there, and probably my next favorite is Google right here with the trend line holding off of here. This is a pretty long-term trend line going all the way back to like November of 2016. All right, that's basically when Trump was elected. This rising trend line is being tested on Google. So that's a really good risk-reward opportunity, but I'm not going to add here, not because I think I'm wrong on the trade or I don't like the trade. I actually really like the trade. But the reason why I'm not going to get into Google right here is because I don't want to add more exposure, and that's what I'm talking about. You have to manage the exposure, because if I am wrong, I don't want to be wrong Google, Amazon, and Netflix. I'm okay with being wrong Amazon and Netflix, but not all three. So I have to manage it. So yes, maybe this one gets away from me and I never have a chance to play this bottom, but if I am right and this thing does get away from me, that's probably going to mean too that Amazon and Netflix did very well, and I'm happy with those profits. And there'll be other trades along the way that provide similar risk rewards that Google has, and that I can get in long on those as well. So again, you've got to, one, always use stop losses. If you're not going to use stop losses, don't even trade. But two, you have to be willing to fail. You can't nail it perfectly. We're not this we're not traders that have a crystal ball that knows exactly when the market's going to bottom. But what you want to do look for is for that that huge sell-off that creates a huge amount of fear in traders, and then all of a sudden you rally off those lows and you go back into positive territory. That's what we got in February, and that's what we've seen so many times in the past with historic bottoms. So that's what we're looking for today, and the market's trying to do that, and we'll probably know more as the afternoon progresses. But if I am wrong, I'm wrong on 2 trades, which represents about 20% of my portfolio, not the entire net worth that I have. So I'm not putting everything that I own and everything that I am on these 2 positions, and I'm not going to keep adding more and more positions hoping that I'm right on all of them. I need these things to work first before Amazon and Netflix, before I start adding more trades to the portfolio. So willing to fail, using stop losses, managing the exposure. You have to manage the exposure, and then by doing all that, you're going to be managing the risk collectively. So that's how you play the bottoms. That's how I do it. Your typical bottom of late has been V-shaped bottoms. We don't see a lot of bottoms where it just turns sideways for months at a time before it finally breaks out of a base. Going back to 2009, when the market came out of the Great Recession, what we saw was a lot of V-shaped bottoms, and that's been the case ever since. Even when we sold off an election night from the fear about Trump being elected, there was a huge sell-off that night, but there was this huge V-shaped bottom after the NASDAQ limited down and the S&P limited down. There was this huge V-shaped bottom that saw the market just go straight through the roof. So what I'm trying to say is that don't wait around. When the market does start to bounce, you're going to want to add some exposure to your portfolio to the long side. Not all at once, but you know, as the bottom becomes a little bit more obvious that it's been put in place, then you can continue to add more long exposure as a result. So that's how I play the bottoms. I hope this is going to help you guys. As always, stay calm. Be willing to stay on the sidelines if you're not quite sure, and just continue to trade away. Take care and God bless. Thanks for watching. I hope you enjoyed the video. Please be sure to like and subscribe to my channel, as well as check out some of these other cool videos that I've done. And if you want to swing trade with me each and every day, you can do so by going to www.shareplanner.com/splash zone. Thanks and happy trading.